Picture this for a moment. Right now, as you're watching this video, every single country on planet Earth is drowning in debt. The United States alone owes a staggering $38 trillion. Japan carries over $9 trillion in debt. And when you add it all up across every nation, corporation, and household on Earth, the total comes to an absolutely mind-boggling $346 trillion. That's nearly 4 times larger than the entire global economy. But here's the question that should keep you awake at night. If literally everyone owes money, who exactly is getting paid? Where does all this debt actually lead? The answer isn't what you think. And once you understand it, you'll see the modern financial system in a completely different light. What I'm about to show you isn't some conspiracy theory cooked up in someone's basement. This is documented history, verifiable facts, and publicly available records that reveal how a handful of brilliant minds across 3 centuries engineered a system where debt can never truly be eliminated. They created a machine where governments must borrow forever, where interest payments flow endlessly upward, and where the very people who designed this trap profit from every crisis, every bailout, and every payment. The global debt isn't a problem that needs solving. It's the system working exactly as intended. And to understand how we got here, we need to follow the money through 4 crucial moments in history where 4 different architects each added a piece to this elaborate puzzle. Let's start at the beginning, back in 1694, England. Before this pivotal year, when kings needed money, they did what seemed logical. They'd approach wealthy merchants or nobles, promise to pay back the loan with interest, and hope for the best. Sometimes they'd pay it back. Sometimes they wouldn't. When they defaulted, creditors lost their money, and kings would simply find new lenders. It was risky for everyone involved, but it was also temporary. Debt either got repaid or it got written off. The slate was wiped clean, and life moved on. Enter William Paterson, a Scottish merchant who had failed multiple times to strike it rich. By 1691, he had an idea that would fundamentally reshape how civilization thinks about money and debt. England was engaged in a costly war with France, and King William III desperately needed funding. The royal treasury was empty, tax revenues couldn't cover the massive war expenses, and traditional lenders were refusing new loans because England had a history of defaulting. Paterson approached the king with a revolutionary proposal. He would organize a group of wealthy merchants to lend the government £1.2 million, equivalent to about $300 million today. But here's where it gets interesting. This loan would never be repaid. Not ever. Instead of paying back the principal, the government would pay interest forever at 8% annually. And to manage this unprecedented arrangement, Paterson proposed creating an entirely new institution called the Bank of England. The mechanics were brilliantly simple, yet revolutionary. The merchant lenders would deposit their gold with the Bank of England. The bank would lend that gold to the government. The government would pay annual interest from tax revenue. The bank would distribute that interest to the merchant lenders. But the crucial detail that changed everything was this. The government would never repay the original loan amount. The debt was designed to be permanent. Why would merchants agree to such an arrangement? Because the interest payment was guaranteed by Parliament itself, backed by the government's power to tax its citizens. As long as England existed and could collect taxes, the money would keep flowing. Even better, the banknotes the lenders received in exchange for their gold could be traded and sold to other investors. They were as valuable as money, but better than money because they paid interest. Parliament approved Paterson's scheme in 1694. The Bank of England received its charter. The merchants provided their gold. The government got its war funding. And for the first time in human history, national debt became a permanent feature rather than a temporary problem to be solved. Here's what made this absolutely brilliant for the bankers involved. The government paid 8% interest annually on £1.2 million. That translated to £96,000 per year, flowing from taxpayers to investors forever. The merchants had essentially purchased an annuity from the government. As long as England survived and maintained its ability to tax, the payments would continue indefinitely. If they ever wanted to cash out, they could simply sell their banknotes to someone else. The debt became transferable, but never repayable. But Paterson's real stroke of genius came with what happened next. The Bank of England was granted the extraordinary right to issue banknotes backed by the government as debt. They could literally print paper money up to the value of the outstanding loans. This created something unprecedented, money born from debt. The government's promise to pay became currency itself. The more the government borrowed, the more money could be created. This became the template that would spread across the world. Government borrows money, never repays the principal, pays interest forever from tax revenue, and the debt itself becomes the foundation for money creation. It's absolutely brilliant if you're a banker collecting eternal interest payments. It's catastrophic if you're a taxpayer funding those payments on debt that will never disappear. Within 50 years, every major European power had copied this model. France created similar mechanisms. The Netherlands, already sophisticated in banking, formalized government debt issuance. By 1790, the newly independent United States adopted the identical system under Alexander Hamilton, who explicitly modeled America's financial structure on the Bank of England. Permanent debt, interest paid from taxes, and bonds traded as currency became the global standard. Patterson died in 1719 without accumulating significant personal wealth despite creating the Bank of England, but the system he engineered persists 332 years later. The Bank of England still exists today. British government debt has never been paid off. It's been refinanced, rolled over, and expanded countless times, but never eliminated. The debt trap was established in 1694, and every government since has walked directly into it. By the early 1800s, European governments had fully embraced this debt-based system. They borrowed for wars, infrastructure projects, and daily operating expenses, but the market remained primitive and disorganized. Each loan required individual negotiation. Interest rates fluctuated wildly. Only the wealthiest merchants could participate in government lending. This is where our second architect enters the story. Nathan Rothschild revolutionized sovereign debt by industrializing it. The Rothschild family started as money changers and commodity traders in Frankfurt. By 1800, the 5 Rothschild brothers had established banking houses in 5 major European cities: London, Paris, Frankfurt, Vienna, and Naples. This network was unprecedented in its scope and speed. They could move money across international borders faster than anyone else in the world. Nathan Rothschild, operating from London, was the strategic mastermind. During the Napoleonic Wars, he arranged massive loans for Britain. But his innovation wasn't just in the lending itself, but in how he structured these transactions. Instead of lending directly to the government, Rothschild would purchase government bonds at a discount and then resell them to investors at a markup. He created what we now call a secondary market. Here's how it worked. The government needed money immediately. Rothschild provided it by buying bonds. Then he sold those bonds to pension funds, insurance companies, and wealthy individuals across Europe. The government received its funding quickly. Rothschild collected the difference between his purchase price and selling price. Investors acquired tradable assets that paid regular interest. Everyone seemed to win. But this is where the system becomes darker and more controlling. Rothschild didn't just finance governments. He positioned himself so that governments had virtually no choice but to work through him. The famous example occurred in 1815 at the Battle of Waterloo. Nathan Rothschild learned of Napoleon's defeat before anyone else in London because his courier network was faster than official government channels. He used this information advantage to manipulate the entire bond market. First, he began selling British bonds heavily, signaling to the market that Britain was losing the war. Prices collapsed as other investors panicked and sold their holdings. After prices had crashed to rock bottom, Rothschild quietly bought massive quantities at severely discounted prices. When official news of British victory arrived the following day, bond prices surged dramatically. Rothschild made millions, not from what we'd call insider trading today, but from controlling information flow and market timing. This established what became known as the Rothschild model. Control the information, control the bond issuance, and control the market itself. By 1820, the Rothschilds dominated European sovereign debt. If any government needed to borrow money, they essentially had to go through the Rothschild network because the Rothschilds controlled the distribution channels to investors. They possessed the relationships, the infrastructure, and ultimately set the terms. Here's why this development was crucial for understanding today's debt trap. Before Rothschild's innovations, governments could theoretically default on their debts. If a king refused to pay, his creditors lost money, but the damage was contained and localized. The system would reset, and borrowing could resume with different parties. But Rothschild made sovereign debt internationally tradable and interconnected. A British government bond might be owned by a French investor who later sold it to a German bank, which then used it as collateral for a loan to an Austrian aristocrat. The web of ownership became so complex and interconnected that defaulting was no longer simply a matter of refusing to pay one creditor. Default would trigger the collapse of an entire international financial network. This represents the Rothschild innovation. Make debt so globally interconnected that default becomes practically impossible, not because governments are inherently responsible, but because default would cause systemic financial collapse across multiple countries. Governments became trapped in the system. They had to continue making payments, and they had to continue borrowing new money to service the interest on existing debts. The debt trap evolved from being merely permanent to being completely inescapable. The Rothschild family's wealth peaked during the mid-1800s, when they were the richest family in the world, wealthier than any monarchy. That wealth derived from a single source: interest payments on sovereign debt. They didn't manufacture products or build infrastructure. They lent money to governments and collected interest payments forever. The system that Patterson created in 1694, Rothschild had industrialized and globalized by 1815, trapping every European government within it. As we move into the 20th century, America was rapidly becoming an economic powerhouse, but it still operated with a relatively primitive financial system. Banks functioned independently without coordination. The money supply remained tied to gold reserves. There was no central mechanism to manage debt issuance or coordinate responses to financial crises. This is where our third architect, J.P. Morgan, entered the scene. In 1907, a severe financial panic struck the United States. Stock prices crashed, banks failed across the country, and the entire economy ground to a halt. With no central bank or government mechanism to respond, J.P. Morgan personally organized a massive bailout operation. He gathered the most powerful New York bankers in his private library, literally locked the doors, and forced them to pledge their own money to stabilize failing institutions. His intervention worked. The panic subsided, and Morgan effectively became the unofficial central banker of America. But Morgan was 70 years old and recognized he couldn't personally manage future crises. So Morgan and his associates, representing the most powerful banking interests in America, designed a permanent solution. They needed a central bank, but Americans historically despised central banking. Both the first and second banks of the United States had been shut down due to populist opposition against concentrated financial power. Morgan's group solved this political problem through clever disguise and misdirection. In 1910, Morgan's closest associates, including Senator Nelson Aldrich and representatives from the nation's largest banks, held a secret meeting on Jekyll Island, Georgia. For 9 days, they designed the structure of what would become the Federal Reserve System. The meetings were conducted in complete secrecy because they understood that if the American public discovered that bankers were designing the national monetary system, there would be widespread riots and political upheaval. Their plan was a masterpiece of political manipulation and public relations. The new institution wouldn't be called a central bank, which Americans opposed. Instead, it would be called the Federal Reserve System, suggesting government control and decentralization. It wouldn't operate as a single institution, but as 12 regional banks, appearing to distribute power geographically. It wouldn't be directly controlled by Wall Street, but overseen by a board of governors appointed by the president, creating an illusion of democratic oversight. But the actual structure ensured that bankers maintained ultimate control. The regional Federal Reserve banks were privately owned by member banks within each region. Those member banks elected the boards of directors for their regional Federal Reserve banks. The regional Federal Reserve banks then influenced the selection of the Federal Reserve Board of Governors. While the government appointed some members, the banking industry controlled the fundamental operations of the system. Most critically, the power to create money and purchase government bonds was concentrated in the Federal Reserve Bank of New York, which was controlled by the largest Wall Street banks, including Morgan's own institutions. The Federal Reserve Act passed Congress in December 1913, largely because most representatives didn't fully understand the legislation they were approving. Immediately upon implementation, the debt trap expanded dramatically. Now the government could borrow not just from private banks with limited resources, but from the Federal Reserve, which possessed the power to create money specifically to purchase government bonds. This represented unlimited demand for government debt. Here's why this development was revolutionary and dangerous. Before the Federal Reserve existed, there were natural limits to government borrowing. Banks could only lend money they actually possessed or could attract from depositors. But the Federal Reserve could create money by purchasing government bonds. The process worked like this. The government issues a bond representing a promise to pay. The Federal Reserve purchases that bond with newly created money. The government spends the money into circulation, and the debt appears on the Federal Reserve's balance sheet, backed by nothing except taxpayers' promise to service it indefinitely. This mechanism enabled infinite debt expansion. The Federal Reserve guaranteed there would always be a buyer for government bonds, ensuring constant demand regardless of market conditions. The government never had to stop borrowing because the Federal Reserve would always purchase additional bonds. Debt could be rolled over perpetually because the Federal Reserve provided unlimited market support. Morgan died in 1913, the same year the Federal Reserve was established. But his legacy created the structural foundation that makes today's $38 trillion in United States debt mathematically possible. Without the Federal Reserve serving as a guaranteed purchaser, the private market couldn't support borrowing at such massive scales. But with the Federal Reserve providing unlimited buying power, there are essentially no limits to debt expansion. The debt trap became infinite in scope. By the 1970s, the debt system that Patterson, Rothschild, and Morgan had constructed was operating globally across all developed nations. Every major country borrowed continuously, rolled over existing debt, and made regular interest payments. But developing nations presented a different challenge. They borrowed primarily for infrastructure development, and many struggled to maintain payment schedules. The debt trap appeared to be reaching natural limits until our fourth architect intervened. Paul Volcker served as Federal Reserve Chairman from 1979 to 1987, and he faced a critical problem. Inflation exceeded 10% annually. United States credibility was deteriorating internationally. Foreign governments were losing confidence in the dollar's stability. He needed to restore faith in American monetary policy, even if it required causing a severe recession. In 1979, Volcker raised interest rates dramatically. The federal funds rate increased from 11% to 20%, the highest levels in American history. This policy successfully crushed inflation, but created an unexpected secondary effect. Developing nations had borrowed hundreds of billions of dollars during the 1970s when interest rates were relatively low. Now those loans were coming due, and interest rates had effectively tripled. Mexico owed $80 billion. Brazil owed $60 billion. Argentina owed $40 billion. The interest payments alone exceeded their entire export revenues. These countries simply couldn't meet their obligations. In August 1982, Mexico announced it couldn't make scheduled payments. This represented outright default. This situation should have triggered a global financial collapse. American banks had provided most of those loans to developing countries. If Mexico, Brazil, and Argentina all defaulted simultaneously, Citibank, Bank of America, Chase Manhattan, and other major institutions would face catastrophic losses. Some might have failed entirely, potentially bringing down the entire banking system. Volcker could have allowed market forces to operate naturally, let the banks absorb their losses from bad lending decisions, let the market clear through defaults and restructuring. But he chose a different path. Instead of permitting natural market clearing, he orchestrated an elaborate bailout through the International Monetary Fund. The IMF would lend Mexico, Brazil, Argentina, and other debtor nations sufficient money to continue making interest payments to American banks. These loans were called structural adjustment programs, and they came with extraordinarily harsh conditions. Governments had to drastically cut public spending, privatize state-owned assets, open domestic markets to foreign investment, devalue their currencies, and essentially dismantle their economic sovereignty in exchange for money to service existing debts. Here's the crucial detail that reveals the true nature of this system. The IMF loans did not reduce the total debt burden. They simply rolled existing debt into new arrangements, made payments more manageable in the short term, but ensured the debt remained permanently in place. This represents the Volcker innovation. When debt becomes unpayable, don't forgive it or allow natural default. Instead, restructure it through additional lending that keeps interest payments flowing while extracting political and economic concessions. The debt trap evolved into a tool of international control. Countries that couldn't meet payment schedules were forced to surrender economic sovereignty, sell national assets, and submit to foreign economic policy direction in exchange for the privilege of remaining perpetually indebted. This pattern has repeated consistently for 40 years. Greece in 2010, Argentina in 2001, Sri Lanka in 2022. Every crisis follows the identical structure. IMF loans to maintain interest payments, severe austerity measures imposed on populations, sovereignty surrendered to international creditors, and debt levels restructured but never eliminated. Volcker died in 2019, but his legacy established the mechanism ensuring the global debt trap is both comprehensive and inescapable. Even when countries become unable to service their obligations, they're not permitted to default and start fresh. They're refinanced into permanent indebtedness while interest continues flowing to the same institutions, the same banks, the same system that Patterson created over 3 centuries ago. Now let me show you exactly how these 4 architects constructed a system where debt has become infinite and escape has become impossible. Start with Patterson's foundational model. Governments borrow money, pay interest forever, but never repay the principal amount. Add Rothschild's crucial innovation. Make debt globally tradable and interconnected so that it's not held by a single creditor, but distributed across complex international networks where default anywhere threatens systemic collapse everywhere. Incorporate Morgan's mechanism. Central banks create money specifically to purchase government bonds, providing unlimited demand that ensures governments can always borrow additional funds regardless of market conditions. Finally, implement Volcker's trap. When countries can't meet payment obligations, restructure rather than forgive debt, maintain interest flows, and extract sovereignty concessions in the process. The result of combining these 4 innovations is exactly what we observe today. $346 trillion in global debt that encompasses government debt, corporate debt, and household debt. None of this debt will ever be fully repaid. All of it generates ongoing interest payments. All of it remains interconnected through the international financial system, so that default anywhere threatens collapse everywhere. Here's the specific mechanism operating today. The United States government has issued $38 trillion in debt obligations. Who actually owns this massive debt? Approximately $20 trillion is held by American institutions and individuals, pension funds, mutual funds, insurance companies, banks, and the Federal Reserve itself. These institutions purchase treasury bonds because they're considered the safest possible investments, but those bonds pay substantial interest, approximately $1 trillion annually. That interest comes directly from tax revenue. Taxpayers send money to the government through various taxes. The government transfers that money to bondholders as interest payments. The bondholders are primarily institutions owned by or serving wealthy individuals. It represents a continuous transfer of wealth from working people to capital owners, occurring every year, forever. The remaining $18 trillion is technically owed by the government to itself through programs like Social Security and Medicare trust funds. The government borrowed money from these programs and spent it on other priorities. Now it owes itself. But ultimately, taxpayers remain responsible because when Social Security needs to redeem those bonds to pay benefits, the government must either raise taxes or borrow additional money to honor the obligations. Now scale this mechanism globally. Japan owes $9 trillion, mostly to Japanese institutions and the Bank of Japan. Europe owes $14 trillion, primarily to European banks and the European Central Bank. China carries significant domestic debt held by state-controlled banks. Every country operates the identical system, and they're all interconnected through complex relationships. Japan holds United States Treasury bonds. The United States holds European debt through International Monetary Fund participation. Europe holds developing nation debt through World Bank involvement. It's completely circular. Everyone owes everyone else, and interest payments flow upward to institutions that manage the debt. Here's why the system can never end naturally. If the United States government somehow paid off its entire $38 trillion debt, the money supply would collapse dramatically. Dollars are created when the government borrows money. If the debt disappeared, those dollars would vanish from circulation. This would cause deflation, depression, and complete economic collapse. The government literally cannot pay off the debt without destroying the economy. The same principle applies globally. If every government simultaneously paid off all debt, the global money supply would shrink by approximately 2/3. There wouldn't be sufficient money remaining in circulation to conduct international trade. The entire system would seize up and stop functioning. Therefore, debt cannot be eliminated because it's structural and necessary for the system's operation. And here's who profits from this arrangement: the institutions that hold the debt. BlackRock, Vanguard, State Street, and Fidelity. These asset management companies control tens of trillions of dollars. They purchase government bonds using other people's money from pension funds, retirement accounts, and insurance premiums. They collect the interest payments, approximately $1 trillion annually from United States debt alone, plus similar interest streams from Japan, Europe, and developing nations worldwide. That $1 trillion per year in interest payments represents a continuous wealth transfer from taxpayers to bondholders. It's the largest ongoing wealth transfer in human history, happening continuously, embedded in the system's structure and invisible to most people because it's not labeled as a tax, but rather as debt service. However, the mechanism is identical. Workers pay through taxes, institutions collect through interest, and the debt never decreases. Now, here's the final piece that reveals the complete picture. The four architects I've described didn't conspire together across centuries. They lived in different time periods and faced different challenges. But each one solved problems in ways that systematically benefited banking interests, and each solution built upon previous innovations. Patterson made debt permanent in 1694. Rothschild made it globally interconnected in 1815. Morgan made it infinite through central bank money creation in 1913. Volcker made it inescapable through restructuring mechanisms in 1982. Together, they constructed a system where governments must borrow forever and pay interest eternally to the financial institutions that control the bonds, manage the debt, and collect the interest. The ultimate beneficiaries aren't governments or taxpayers, but the financial institutions themselves. And here's the final truth that changes everything. $38 trillion in United States debt is not a crisis for these institutions. It's a profitable business model. Every dollar of debt represents an asset on someone's balance sheet that pays regular interest and provides collateral for additional borrowing. As long as public confidence holds, as long as people believe the government will continue paying interest even if it never repays the principal, the system functions smoothly and generates enormous profits. The debt trap is now complete, and escape isn't possible without collapsing the entire financial system. Four architects across 3 centuries, one interconnected system, and everyone on Earth is now caught inside it. If this analysis has changed how you understand government debt, if you now recognize that $38 trillion isn't an accident or policy mistake, but represents a system working exactly as designed, then you're beginning to see how real power operates in the modern world. The conventional education system won't teach you this perspective. They'll continue teaching that debt represents a problem requiring solutions. But the architects understood something different. Debt isn't a problem within their system. It's the foundation that supports everything else, and interest payments represent the rent that everyone pays to live within their carefully constructed financial architecture. The machine continues operating precisely as intended, generating wealth for those who designed it while keeping everyone else trapped within its mechanisms, believing there's no alternative way to organize economic relationships. The numbers might be larger now, the relationship's more complex, but the fundamental structure remains unchanged from Patterson's original innovation over 3 centuries ago. The debt trap has evolved, but its essential purpose remains constant, ensuring that interest flows eternally upward to those who control the system itself. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.